Okay. We've all heard that saying, of course, about we learn from history that we learn nothing from history. George Bernard Shaw was an intriguing one to have. Winston Churchill, a similar sort of argument. I think the comic says it best, because some people do learn from history, and then what you do is you tolerate people not learning from history, going ahead and making the same old mistakes. Like we can see that not just in economics, we can see it happening with politics and international relations at the moment, which I find absolutely appalling. That the one that I found most intriguing, talking about what do we learn from history, is Hegel. Ever heard the name Hegel before? Good. Okay. And he talks about how we often tell rulers that they should learn from history, but he said people have never learned anything from history or acted on the principles you can deduce from it. But he made this important point here, that each period is involved in such peculiar circumstances, had such idiosyncratic conditions, he said that its conduct must be regulated by considerations connected with itself rather than the general principles. And so when you have the pressure of great events, a general principle gives no help, he claims. It's useless to revert to similar circumstances in the past. Lovely final phrase, the pallid shades of memory struggle in vain with the life and freedom of the present. Now, having worked with a few people who've been worked in Prime Minister and Cabinet back in Australia, the one in particular was a journalist that became a good friend, and he said because he was a journalist himself, he would easily talk to people in the press gallery. He remember coming out one day out of a meeting in Paul Keating's cabinet and saying, "Oh, it's chaos inside there." And the journalist saying, "Oh, you're kidding, haven't you guys got some sort of a plan?" He says, "No, our plan's to react to events," which is all we really ever do. And what it tends to happen as well is people react to events by doing the one thing they share, and this is where Hegel gets it wrong. They share a similar education, and the one thing they have in common most of the time is first-year economics. So what you end up getting out of a cabinet decision tends to be a simplified version of Economics 101, because it's the only general principle they can actually learn from. So I think a general principle, it's wrong to say it gives no help. It might give a hindrance as well as a help, but it certainly it turns up in people's minds. And it's also, it isn't necessarily so that you must regulate things by the current experiences. You can do otherwise, but of course it tends to be that people do just react to the events and go forward that way. But general principles, as well as giving no help, can also sometimes undermine any learning you might do about the past, because those general principles can conflict with the actual cause of the crisis you're dealing with. If you think about the most recent financial crisis, what's the event that you think most of? What do you think caused the crisis? Any ideas? Pardon? Subprime lending, that's the thing we come to. And was there subprime lending back in the 1920s? There was actually a fair bit of mortgage fraud at various times, but the mortgage bubble tended to be in Florida in the early 1920s, long before the actual crisis. So in that sense, you could say that if you think about the 1920s, what do you think of instead of subprime? Depression, with the stock market crash in 1929. Okay, that's those two events. You know, one's a stock market crash, the other's a housing bubble crash. They're both crashes, but they're both quite different in what drives them. One was driven by marginal lending, the other by mortgage. One was sent through the public in general. The other was focused just on those in the stock market. So people will focus on the idiosyncratic, and all the reactions you see about what do we do about this crisis are all about how do we stop another subprime happening. But it might not be going on the actual general principles of what actually caused the crisis. And this is my feeling, that we have to have a set of general principles that dominate how economists think about the economy and macroeconomics that actually conflict with what actually caused the crisis, and make it impossible to understand them. So if you look at these two crises, the general principles that neoclassicals will apply, I can really summarise like this. First of all, private debt can't cause a crisis. That's still the perspective they've got today. And secondly, you can easily end a crisis by Federal Reserve action. And that's the lessons that Bernanke drew in his so-called research, and I'm part of being very sarcastic there, but I don't think he's done what I regard as decent research at all, on what caused the Great Depression. So he wrote that this starting point, I think, is quite valid. Because the Depression was characterised by sharp declines in output and prices, the premise that he has of his essays on the Great Depression was that a decline in aggregate demand was the dominant factor. And that gave him two questions which again reflect the fact that he's coming from a neoclassical point of view on the economy. First of all, what caused the collapse? That's the aggregate demand problem. And secondly, why did it last so long? This is where his a priori thinking is very neoclassical. It says, why didn't the normal stabilising mechanisms of the economy kick in? And notice those normal adjustment mechanisms as he sees them are adjustments to wages and prices, so that there's a limited impact on real demand of a fall in aggregate demand. Because from the neoclassical point of view, things which affect money and prices things which affect money and nominal demand shouldn't have much impact upon real output and real demand. So prices should adjust. Prices should take most of the hit of an increase in the money supply for inflation or a decrease in the money supply for deflation, and overall the real economy shouldn't move all that much. That's the prior who's coming from. Now, another economist who was neoclassical in the 1920s but changed his stripes very dramatically in the 1930s was Irving Fisher, and he saw private debt as playing a key role. Now, Bernanke dismissed that on what I'm calling a priori grounds. You all familiar with the word a priori? Okay, some of you aren't. It's a Latin term. It effectively means before the event. So if you have a set of reasoning principles that you've logically derived from some starting point, you're applying those to the facts rather than looking at the facts and trying to induce something. So you know the difference between inductive and deductive logic? You've heard that as well? Okay. Deductive, you start from a set of principles like about how to divide numbers and you work out how to do the division. Inductive will give you a sequence of numbers and say, how is this sequence of numbers derived? Can you find a pattern in the data that tells you how the numbers are derived? So deductive is working from a set of principles you've worked out beforehand. Inductive saying, look at the data, what can I work out from the data? So he's doing it on a priori grounds. And this is his reasoning. He said that debt deflation was first developed by Irving Fisher, which is true. He said Fisher envisaged a dynamic process in which falling asset and commodity prices created pressure on nominal debtors. Notice he says nominal debtors there. What other sort of debtors are there? Any idea what he means by that? What he's saying is debts denominated in money terms. If you have a debt to the bank, it's stated in a certain amount of hundreds of thousands of pounds rather than hundreds and thousands of nails or hundreds and thousands of pigs, etc., etc. So it's a nominal debt denominated in dollars. But of course, I can't think, there are virtually no debts that you could think of today that are denominated in anything other than money. So it's curious he sees an importance to mention that it's nominal here. Okay. But it says pressure on nominal debtors forces them to distress sales, which lead to further price declines and financial difficulties. So it's a strong argument about where the Great Depression came from. And he mentions that Fisher's argument, Fisher was still pretty influential even though his reputation was destroyed by not seeing the crisis coming back in the 1920s. He still could get the ear of the president, and he argued the president should reflate the economy and ignore the impact on the exchange rate. But Bernanke continues that Fisher's idea was less influential amongst academics because of the counter-argument that debt deflation is no more than a redistribution from one group, debtors, to another group, creditors. And he then says, absent implausibly large differences in spending propensities, pure redistributions should have no macroeconomic impact. So he pretty much dismissed on a priori grounds the argument that, given what he thinks about private debt, all that's going on is a transfer of money from savers to borrowers. And unless there's really big differences in how much they're willing to spend out of the money they've got, it shouldn't affect the macroeconomy all that much. So he then, having said it wasn't anything to do with the level of private debt, his only nomination he was left with was the Federal Reserve. Looking back at the Federal Reserve, he said that the Federal Reserve, its discretionary policy was destabilising. Now what he meant by this was, as I'll show you in data in a moment, the Federal Reserve is reducing the money supply, reducing its contribution to the money supply in the lead up to the crisis, and he saw that as being where the crisis came from. So he said, Bernanke, he's a disciple of Milton Friedman, really probably Milton Friedman's biggest fan. And Friedman said there are three determinants of the money supply. One is base money, or currency plus bank reserves. So if you think of the notes in your pocket, there are also notes inside vaults, both of banks and of the central bank, and then bank reserves, which are the both the bank deposits that the private banks have at the central bank. And that's called high-powered money. And then there's a money multiplier, and that's supposed to be the ratio of bank deposit money to bank reserves. And then finally the ratio of bank deposits to currency, because if people hold on to money in notes rather than putting it in banks, then the money multiplier can't work on that particular part of the money. So those three factors together, he saw as, and following Friedman, he saw those as determining the money supply, and said the Federal Reserve's actions on those various elements is what caused the crisis by reducing aggregate demand so much. So this is from Friedman, and Friedman argued that the monetary system we have consists of notes and deposits held by the public on the part of fractional reserve commercial banks. So this is the whole idea about fractional reserve. And he says there are three major channels through which a change in the stock of money must, as a matter of arithmetic, occur. So the first is this high-powered money. That's the amount of hand-to-hand currency held by the public, plus cash in vaults, plus the deposit liabilities of the Federal Reserve Bank system to the bank. So these are the deposits of the private banks in their accounts at the central bank. That's what reserves are. And he said it's called high-powered money, and this is the money multiplier argument, because $1 of such money held as reserves may give rise to the creation of several dollars of deposits. Okay? And this is the whole money multiplier. You've had that explained to you in macro classes, and I went through a bit of it fairly critically, as you might remember, a few lectures ago. So that's seen as being the base from which money is created. The second bit is the ratio of commercial bank deposits to bank reserves, and the higher the ratio, the larger the amount of deposits that you get for a certain amount of reserves. So a very high ratio means a large amount of money creation with the money multiplier. And the final one is the ratio of bank deposits to currency, because the more currency that people hang on to rather than putting into a bank, the less the money multiplier power is going to be. So that's the overall logic. And what they say is the Great Depression was caused by a fall in the money supply. The fall in the money supply was the fall of the Federal Reserve. And there were two elements to this. Partly there were bank failures, and back in those days they didn't have deposit insurance. So if a bank failed, depositors lost their money, which gave people an encouragement to take their money out of banks and hang on to it in cash, which is reducing the third factor that they've both spoken about. So that's something which was the, if you like, the endogenous trigger to a crisis that they perceived. So you have bank failures, people take their money out of the banks, the money multiplier falls. But they believe the Federal Reserve could have countered this by increasing the amount of base money, so increasing the amount of reserves and cash in circulation. And that's the logic that if the Federal Reserve didn't do that, that's why the crisis occurred. Now, the lesson Bernanke learned from this was he was Federal Reserve Chairman when the crisis began in 2008. So having criticised the Federal Reserve what it did wrong back then, you might expect his behaviour to be somewhat different and informed by those general principles, which it was. So before that all happened, writing about how does one stop deflation, this is his confidence that deflation could be prevented by monetary policy. So he said if you have a paper money system, a government can always generate increased nominal spending, even when we're at the zero interest rates, which at that stage they weren't. They were running about 4 or 5% back then. He said, so the US government has a technology called a printing press, or today's electronic equivalent. In other words, the capacity to make entries in your bank accounts and matching ones in theirs to generate money. And said that it allows it to produce as many US dollars as it wishes at essentially no cost. And by increasing the number of dollars in circulation, it can reduce the value of a dollar in terms of goods and services, which is the same as causing inflation. And he then said we conclude that under a paper money system, a determined government can always generate higher spending and achieve positive inflation. So that's the lesson that he's learned from this, the general principles that he learns from being neoclassical and following Milton Friedman. Well, if you look at the inflation rate, and this again is something you need a bit of history to be aware of. Back in the 1980s, inflation was as high as 15% in America, and similar levels in England. Basically, it was a global phenomenon. And then you can see it's rapidly dropped down to about between 2 and 4% from 1982 all the way through to 2008. Then the crisis hit, you went to deflation. See, for this period, this line here is zero. So just after the crisis began, inflation was almost 6%. And then within 2 years, and much less than that in fact, it had dropped to minus 2%. So you had a 7% change in the rate of inflation over about maybe 1.25 years. Then back up again But notice now, pardon me, we're back to the stage of pretty much zero price increases. The same as is applying in England, because the price of inflation here is about -1 or -2%. So we have deflation. Okay. And his argument is that they can prevent deflation, so why hasn't he succeeded in preventing it? Yeah.
Could you go back to one slide?
Yeah, sure. Hang on a sec. That one?
Yeah, I don't know where I was reading, but I was reading that back in the 70s and 80s, like the data showed, the inflation was 15%, and now it's obviously standing at 3%. Someone, I was reading an article about it saying that even today it's equivalent to the 15% on the floor, but the CPI and the RPI changed.
Yeah, I wouldn't say it's equivalent to 15%, but the statisticians are always changing definitions of economic aggregates, which make life rather difficult when you try to compare data over time. The main changes that occur relate to how much they value the value of computers, for example, which didn't exist in any grand scale back in the 80s. And what they'll do with computers is they'll use what they call a hedonic index. Hedonic, hedonism, pleasure. Okay, they say that the computer now. I mean, I bought a laptop computer in 1988, I think. I paid in dollar terms then in Australia, which is about effectively half it to get pounds. I paid about $13,000 for it, which would be about £7,000. Okay. Now this computer I've got here, I paid £2,000 for. So if you just looked at the price contribution, you'd see the price contribution has fallen. What they do is they multiply the value of the computer by something that's supposed to reflect how productive it is, which is what they call the hedonic index. So that, therefore, turns up as part of the output level of the economy, and then that also, given the amount of money, gives you a measure of prices. So that's been a variation there. And also they include and sometimes remove housing costs. So sometimes there'll be cost of a mortgage will be in there, sometimes they won't. Often they also impute rents. You know the idea of imputed rents? Okay. If you're renting, I take it, or living with parents? Okay. If you bought a property as a landlord to rent it out, then of course you get a rental income. But if you buy a property and live in it, they also record that as being imputed rent to you, and that's part of GDP, which is crazy. I mean, there's plenty of other things they could put monetary value on, but they don't. Okay, but they do on imputed rent. So that then varies your numbers, and that changes your calculation. So I don't think you could argue that inflation now is as high as it was back then, but I think you can argue that comparison over time is slightly misleading. Okay? Good point. Now, let's look at what Bernanke did. That's base money. Okay? You can see from 1980 all the way throughout to 2008, it was basically constant. There was no change in bank reserves, fundamentally, for 25, almost 30 years. And then after the crisis hit and he realised it was a serious crisis, incredible increase in the amount of money in reserve money in the economy, in the belief that would kick off the money multiplier, and by increasing base money, even if the money multiplier had dropped because people were fearsome about their money not being safe in banks, there would therefore be this dramatic increase in money because of the money multiplier. Now let's take a look at just in terms of percentage of GDP, which gives you a better comparison over time here. So you see, back in 1960, the level of bank reserves was about 3.5% of GDP. Now, because there was no increase in reserves over that time, they fell to a bit less than 0.5% of GDP by the time the crisis hit. And in 1 month, I think he increased it to 6% of GDP. And finally, it finishes up at about 15 to 17% of GDP, far higher than it's ever been before. So if the money multiplier worked, kicking that much base money in, even if there'd been a decline in the ratio because of people wanting to hold cash rather than have bank, there should have been a huge increase in money supply. Fair enough? Okay, what happened? A few more comparisons here, by the way. That's showing the increase on an annual basis. And you can see again, all the way through, the increase is basically zero in money terms, rather than percentage of GDP. And then in 2008, 2009, he's increasing it by a factor of 20 every year. The gigantic stimulus into the economy. The biggest I think we've ever seen. I know we've ever seen. Now, if that was the case, huge increase in base money, there should have been something like 5 or 10 times the same increase in money in circulation, according to the model, over time. That's going in the reverse direction, pardon me, mistake of mine. But you can see that the bottom, the red line is the reserves, huge increase in reserves. M1 is money which is immediately available, so that's your savings accounts, which you can go and just put your card on the wall and get cash out of the machine, or cheque accounts, which these corporations still use. That's immediately accessible money. M2 is money, includes M1, plus money that you have to wait some time for, so time deposits, anything which is, I think money market funds are inside there, so even stuff which is inside a speculative vehicle inside the stock market is counted, but you've got to wait, you've got to spend some time to get your money out of those. So this is immediately available money, and that's money available with a bit of a time lag. And you can see dramatic increase in base money. These two change a bit, but you can see for a while this huge increase was going on in base money, M2 was actually increasing more slowly. So there was something very ineffective about his printing press. Now there's showing the red line again is the annual increase in the amount of base money. The black and blue and pink lines, or purple lines, are the increases in currency M1 and M2. Can you see them? They don't even turn up on the scale, do they? You get a 2,000% increase in base money. What's the increase in the other sorts of money? We've got to actually graph it with a 100 times smaller scale to even see it. So I'm graphing currency M1 and M2 on the right-hand axis now. So the top of the left-hand axis is 2,100% increase per year, which is huge. The right side is 21%, which is trivial. Now, you can see there was a boost of some sort to the amount of M1 and M2, and more M1 than M2. It was more effective on immediately available money than it was on time-delayed money, what they call broad money. But it's trivial. Okay? Now, to really put it in context, again, this is a good for your point about how do you compare. Let's compare apples with apples. What I'm looking at here is the percentage of GDP of those increases. So you get an idea, what's the percentage increase of base money? What was the percentage increase of the broader measures of money? Now, if the money multiplier model made sense, and the ratio, let's say it was between 5 and 10 to 1, then for a 5% increase in terms of GDP of reserves, we should have seen a 15, 25, maybe even 50% increase in base money, in broad money. Instead, you can see broad money actually rose by less than reserves. Okay? So the boost to reserves was greater than the change in available money. So in that sense, the money multiplier was less than 1, which is not the sort of thing that the neoclassical textbooks think is reality. So they've got a real problem here. And if you look back and see what were they thinking, were they actually thinking this boost to reserves would cause a boost to money in the economy? The answer is clearly yes, because Obama is a lawyer. Okay? I think he's a very intelligent lawyer. He's certainly about the only American politician I can stand listening to, with reasonable wit and intelligence. But he relied upon his economists for advice about what to do. And he then put the speech about what they were doing in his Obama speech, which I think is quite a distinctive form of language. He said there are a lot of Americans who understandably think the government money would be better spent going directly to families and businesses instead of banks. In other words, the public thinks, put the money in our bank accounts, don't give it to the banks. Where's our bailout, they ask. He said the truth is $1 of capital in a bank can actually result in $8 or $10 of loans to families and businesses, a multiplier effect. So he was relying upon that multiplier effect, and he thought that by Bernanke increasing reserves that much, there'd be 8 or 10 times as much activity happening in the real economy. Now you look at it, and in fact it was the other way around. By putting in the dollar into the banks, households maybe got 80 cents. So the money multiplier was not a multiplier, it was a money divider. And if you look at the so-called money multiplier relationship, it's far, far different either side of the crisis. Looking up to the 2008, M2 was 170 times larger than bank reserves. So not 10 times larger, 170 times larger. So even in terms of the big as a multiplier is supposed to be in normal times, it was far bigger than they thought it should be. Not a very effective control mechanism. But after it was 5. Okay? There's something seriously wrong with this general principle, which is the point of this lecture. Let's look at the money multiplier. This is now the ratio of various types of money to the to base money. And you can see this incredible stimulus in reverse now, because that's when he starts pumping up base money. And the ratio of the ratio of broad money, M2, to reserves goes from 170 to 1 down to about 5 to 1. Totally failed. This, again, the analogy is a bit like putting your foot on the accelerator and the car just doesn't move. Okay? Maybe chunders forward a couple of steps, but nothing like what you expect to have happen. And the only way you can really see that, it's such a gigantic collapse, I can only really show it effectively on a log scale. So we've now got log measurement on the right-hand side. You can see the ratio falling from close to 200 down to 10 in response to that increase in the amount of base money. So base money goes up, nothing seems to happen to broad money. And then over time that continues declining. So we've now gone to the stage where the ratio between reserves, available reserves, and M2 is about 5 to 1. And you look at currency to reserves, I mean, it's trivial. So reserves actually exceed currency now. There's more reserves held in the bank accounts of the private banks at the central bank than there is cash in circulation. So, why no effect on that at all? It's because the model's a myth. Okay? I'm hammering that point in this particular lecture. I've mentioned it a bit beforehand, but I'm going to hammer it today. And it's been known to be a myth. You can look back at the literature and find people who are in a position to know and actually understand what's going on, and the two are not the same thing. They've been known about it for decades. And my favourite statement of this was made back in 1969 by a senior vice president of the New York Federal Reserve who was trying to stop the experiment with monetarism, which he thought was bound to fail. The reason he thought it was bound to fail was he also said the money multiplier is nonsense. He said the idea of a regular injection of reserves suffers from notice this naive assumption. He's actually accusing professional economists of being naive. The naive assumption that the banking system only expands loans after the system or market factors, meaning people going to the bank and depositing cash in the bank themselves, have put reserves into the banking system. Now, you couldn't be more disparaging than this. In the real world, banks extend credit, creating deposits in the process, and look for the reserves later. They're saying reserves play no role in enabling lending. He said, when there actually will be a demand for reserves, and I'll explain where that comes from, he says the question then becomes whether and how the Federal Reserve will accommodate the demand for reserves, because if there is a relationship required between the two by law, that relationship turns up later. Pardon me, my software getting in the way. You notice this is a very important point, which I'll elaborate on in the lecture. In the very short run, the Federal Reserve has little or no choice about accommodating that demand, but over the long run it reckons it can be felt. So it's a very, very different world when you talk to somebody who knows the practicalities. And another group, I keep on singing their praises here, but I'll keep on doing it because it's such a diversion from normal central bank behaviour. The Bank of England is now saying this in quite a bit of detail. That links to the paper, which I recommend you take a look at. He says, one of the common misconceptions is that the central bank determines the quantity of loans or deposits in the economy by controlling the quantity of central bank money, the so-called money multiplier approach. I said, in that view, the bank implements policy by choosing a quantity of reserves, and there's some constant ratio between reserves and base money, so by changing reserves, you change the amount of money in circulation, the multiplier effect. He said, for the theory to hold, and this is theory, not a fact, the amount of reserves must be a binding constraint on lending, and the central bank must directly determine the amount of reserves. I said, and they don't quite say that's nonsense, but this final line, while the theory can be a useful way to introduce money in banking and economics textbook, it is not an accurate description of how money is created in reality. And you can see at the same time, it's a description of how money is created that Ben Bernanke still believed in 2008. I'll have to buy his book at some stage, and there's the recent book called Courage to Act. I'll have to look at that and see if you can still find arguments about the money multiplier inside there. The Bank of England keeps on going with this argument. It says lending creates deposits. So rather than needing reserves to lend, the actual act of lending creates the deposits. The money multiplier argument pretty much says deposits are needed so that you can lend. And what they're saying, it's reversing the causation and make it direct rather than a lag thing. Lending creates deposits. So say broad money is the measure of the total amount of money held by households and companies, and it's made up of bank deposits, which are essentially IOUs. So if you leave money inside a bank, the bank owes you that money. It's a liability of the bank. And then cash, currency. Okay? That's the basis of the money supply. So of the two types of broad money, bank deposits are by far the majority, so 97% of the money is bank deposits and only 3% is currency. So, and in the modern economy, those bank deposits are mostly created by commercial banks themselves. So very, very different vision to what Bernanke was putting forward about where money comes from. And it gives us a range of questions that I'm going to try to answer in the rest of the lecture. First of all, if banks don't need reserves to lend, why do they need them at all? Okay. They clearly don't play a role in the empirical data in causing lending, so why do banks have them? Now, Holmes makes this comment, in the very short run, the Federal Reserve has little or no choice. Why is it they have little or no choice? Then, if banks don't actually need reserves to lend, how do they lend? And finally, are there any constraints on bank lending? If reserves don't constrain lending, then what does? So those are the questions I'm going to try to go to in the remainder of the lecture. The first one, the main reason is quite simple. Banks interact with each other just like you and I interact with each other. If I go and buy one of you a cup of coffee, or you borrowed some money off me for a train fare, that sort of thing, we interact at that personal level. Then you go shopping. You're interacting with somebody else who's got a bank account at another bank. So you might be shopping at Curry's for a new computer, and you might bank in RBS, and Curry's might bank in Lloyd's. Well, for you to make that transfer, you've got to get money out of your bank and put it in Curry's bank, and that's the role reserves play. So I'm going to have a buyer bank, a agent I'm just calling buyer. That's more like one of you going into a retail shop who banks in buyer's bank, and seller banks in seller's bank. Now, to actually pay for what you're buying, you've got to transfer money not just from your account to the other account, but from your bank to the other bank. So, I've shown you Minsky a few times before. I haven't mentioned this to you, that has anybody installed Minsky on their computer? Nobody? Okay. Give it a try. If you go to a place called SourceForge, I'll show you the link in a moment. I'll bring it up now. Let's see. Do I have a window rolling? No, I don't. So if you go here and just click on the download button, you can download the version for the PC, and you can get Mac and Linux versions by going inside this link here. And once you've installed it on your computer, if you then click on one of these icons you'll see in my lectures, it brings up the software. Okay? So what I've done here is done a model, and I haven't filled it out in any great detail. It's just a skeleton right now. But I've got a person who's in buyer's bank who wants to buy something and is buying it from the seller's bank. So just to show you that, again, it's rather hard to show in terms of I can't make these spreadsheets larger, unfortunately, yet. And I'm showing the operation of buying. If you're going to buy goods from Curry's, you've got to take money out of your bank and transfer it to Curry's bank. So that action actually reduces the reserves that are being held by your bank. And I'll go through it in detail over here in the PowerPoint. So this what explain what are the mechanics of this actually happening, and this is where reserves turn up. So if you just use cash, one way you can do, you can go to the bank, put your card in the auto. What do you call them? Auto banks here or cash machines? Pardon? Cash point. Put it in the cash point. Take out £50. Let's say it's a small purchase, and then you take that with you, and that means your deposit account's going to call by 50. Okay. It also means the bank's cash reserve is going to block because you've literally taken cash out of the bank. Okay, so your deposit account falls, and the amount of cash in the bank also falls. Then you go to the shop, you walk inside and hand over the £50, and the seller will later deposit that cash back in their deposit account. So when they go back, they reverse what you've done. They put the 50 in, the deposit goes up by 50 and the cash in that bank also goes up by 50. So that's the old-fashioned cash way. I see most of you when you go shopping, you use cards these days. It's all FPOS. Anybody buying coffee ahead of me down in the cafeteria is almost always using a card. I'm still stuck in the old cash way. But if you use FPOS, do you know the initial expression FPOS stands for? Electronic Funds Transfer Point of Sale. That's the expression. That's the computing term used to describe it. So you go to an FPOS terminal, which is like the machine down in the coffee places downstairs, and you authorise a transfer from your bank to the seller's account at the seller's bank. Now, what the FPOS system does, it first of all deducts £50 from your buyer account. It adds 50 to the seller's account, and it transfers money from the buyer bank to the seller bank at the central bank. So there's actually you've got to record this operation four times to actually show what's fully going on. So the old-fashioned way of doing it can happen without a bank. This is just showing the cash transfer model. And again, this is just to show the logic. If you double-click on any of these icons, or right-click and choose Open Godly Table, then you'll see the structure of what's going on. So what actually happens here with the buying from the seller, the reserves of the buyer's bank fall, and the reserves of the seller account rises. And I'll explain that signs of that. In fact, I've got a minus sign there rather than a positive. I'll explain that later in the lecture. And from the buyer's bank point of view, all the buyer's bank knows is that money's been taken out of its account, so that the deposit for the buyer has fallen and the bank's reserves have fallen, and the seller bank, on the other hand, it gets a deposit and its reserves have risen. So that's the basic logic. So you withdraw from the cash from the buyer bank, you shop at the seller bank, the seller deposits cash into the seller bank. You could do all of that without putting any money, without actually going near a central bank. Okay? It's just taking cash from one point to another. So you take money out of the bank, and that's the first operation. So you take money out, that's like going to the cash point machine, taking the cash out. You give the money to the seller in return for the goods, and that means you transfer the money to them. And it's complicated from the buyer's point of view. I should have animated that particular slide. I'm sorry I didn't. But first of all, you withdraw the cash. So you've got the cash in your hands. Then effectively, you know, when you go to a shop, you actually got the goods in your hands. Okay. So you've actually got the goods there. That means you've got a liability at that point to the seller. If you try to take those goods out of the supermarket without paying for them, you'd get tackled on the way out. Okay? So you have a liability in monetary terms to the supermarket at that point. So the way you solve that liability is you transfer money across. You give the cash to the seller. Okay? So that's seeing it in 3 points of view. Now, with the FPOS transfer, of course, it's different, but I'll just go through what can go wrong. What happens, for example, if you go to the cash point machine and the cash isn't there? And what I've done in this particular example, I've just hypothetically said this bank has no reserves. Whatever you want to buy, there aren't reserves to match it. Now, of course, if you go to a cash point machine and no cash comes out, you instantly know that's the situation, all right? So you know suddenly your bank has got no reserves, won't give you money back, and the likely impact of that is going to be people panic like crazy and want to get their money out. This is what happened back in the 1920s. This is one of the classic collapses. Everybody's standing up around banks trying to get their money out in cash terms after they've seen a failure with a prepaid depositor. Now, the modern method, on the other hand, goes through the central bank. So you've now got to show the central bank inside that picture. So you have this happening, the transfer there. That happens because at the same time, the bank accounts of the banks also have the same transfer at the central bank. So you bank at a private bank, and you're banking at one bank, the seller's banking at another. The banks themselves both bank at the central bank. They swap their reserves, and it matches your swap of money from the buyer to the seller. Again, I should have animated that. Okay, so first of all, you have, let's see. You're doing, I should have animated that. I'm sorry, I didn't quite get there. I'll fix it up for next year's course. But you've got this transfer here, so I can actually get rid of that. I'll fix it up when I put it on the website. It's going to be too hard to go through it live. But all these transfers, let's see. Okay. So you have a transfer of reserves from the buyer's bank reserves to the savings bank's reserves, and that enables this transfer of money from you to the seller to occur. Okay? Now things can still go wrong, and things have gone wrong in my presentation here as well. What if there aren't enough reserves? So you're not going to experience going to the cash point machine in this particular process and finding there's no cash in the bank you're using because you're doing it using a card. Okay, so you're just going to the shop, you're using a card to make the transfer. But it's possible that your bank has no reserves. So what I'm showing here is the buyer's bank reserves are actually zero. And yet what's required to make your transaction work is that money has to transfer from the buyer's bank's account at the central bank to the seller's bank's account. That has to occur. Well, if you have a cash-only system, and if the central bank insists that the buyer bank has to have adequate reserves, then your transaction can be blocked. You might have $1,000 in your account, okay? But because your bank has zero reserves, you try to make a £50 purchase, and the purchase gets declined. Not because you haven't got the money, but because your bank hasn't got the money. That's possible. Or the central bank could say, we'll give you 30 days to come up with the money. Or the buyer bank on that time can also borrow new money from the central banks. They say, we've got to cover this transaction, lend us the money so we can then make the transaction. Or the buyer's bank can borrow excess reserves from another private bank, which is what happens 99% of the time, because when that transfer occurs, buyer bank's reserves go down, seller bank reserves go up. Seller bank's now got more reserves than it needs, probably because it's been an equal increase in its reserves, which are an asset, and its deposits, which are a liability. They're supposed to have a sort of 10-to-1 ratio, so they only need one of those $10 that's come across they need to hang on to. They've got 9 they might as well lend out and make money on. So most of the time this is covered by having a loan made. So I'm showing the 3 possible ways that this can actually happen. And when you look at the institutional level, this is what central banks do. They give private banks up to 30 days, in fact longer than that in some countries, including Europe, to get the reserves they need. So you can do everything you like in terms of buying and selling. You don't notice any problem at all. But banks can be in deficit to the central bank, having no money in their deposit accounts or negative money effectively. But the central bank lets it happen and gives them time to catch up. And this is an excellent paper this is a Federal Reserve researcher. So again, what I find remarkable is that often the researchers inside an institution like the Federal Reserve will know more about how money is created and the functions of the bank than the chiefs do. The chiefs come in with an academic background, bring across their academic education in mainstream economics, believe that's what's going on below them, but the people actually doing the work know what's actually happening. So this is O'Brien giving a coverage of reserve requirements in the OECD back in 2007. He says there's basically 3 types. There's lag reserve requirements, which he calls LRR, which means you've got time to make a payment. There's semi-lagged, which I don't think he actually explains that at some point. I'll take a look at that in a moment. And finally, contemporaneous. Now, contemporaneous would be if the bank didn't have any reserves and your purchase was justified by your deposit but exceeded what the bank had, your transaction would be turned down. I understand Latvia has a system like that, but it's the only country in the world that does. Now, the reserve requirements of the United States, always my reference economy, as that they have a lagged reserve requirement with a lag of 30 days. So they start computing what the reserve requirements are, and you have 30 days to reach whatever that is, which is plenty of time to arrange a loan from another bank or wait for other deposits to come in and remove the need in the first place. So if you didn't have that lag, on a regular basis, purchases you would be making would fail, because purchases somebody else made would deplete the reserves of the bank such that there was none left for your transaction. Okay? So the payment system would be a total mess. And that's why central banks have a lag requirement for these reserve exchanges. And that answers the second question. Why do they have very little choice? Okay? Why do you have to do it? Well, if you don't do it, the payment system breaks down. Imagine what would happen if you went downstairs to buy your coffee now and found that you, despite the fact you had a couple of £100 in your account, your bank wouldn't let you pay for a coffee because they didn't have any money to cover the transfer from you to the shop downstairs. Okay? So it would be chaos. And it also, that's the main reason, that's the main one that I focus upon too. Another reason is they're trying to manipulate the short-term interest rate. So they have to supply as much reserves as are needed to make sure the settlement rate between banks doesn't move away from the reserve rate. Because when they talk about the Federal Reserve setting the interest rate, they mean they're setting the interest rate banks pay to each other to borrow excess reserves from each other. That's where these negative rates are turning up right now. So I think that's the secondary reason. The key reason is if you didn't let banks get away with not having enough reserves at various times, your financial system would break down completely. And in fact, they did try contemporaneous reserve requirements for 4 years during the monetarist period in America, and they gave up. They returned to lag systems, which are just too dangerous, too difficult. So the lag is 30 days for the Federal Reserve. For the Eurozone, it's 1.5 to 2.5 months. Okay? There's no way reserves can control lending. So, and the other reason, I'll finish on this, we'll have a bit of a break at this stage, they need it for household reserve withdrawals, because what is the question, what are enough reserves? Well, enough for interbank settlements, but that tends to be fairly trivial compared to the total amount of money in the economy, and enough in case households have a panic attack, which they occasionally do. And that's the main reason why you have any required reserve ratios, and quite a few countries don't have them. 6 countries in the OECD don't. It'd be a lot more countries if the euro didn't exist, because the euro lumps together 19 countries, all of whom therefore have reserve requirements. So the ones who don't include the UK. Okay? So you're being taught a model about money creation that doesn't apply in your country, or in mine for that matter. The US has 5 levels. Now take a look at this. I think this is really the killer punch to the whole idea that you can control the money supply using reserves. For household deposits, there's a 10% requirement. Okay? For a large bank, it has to hold reserves equivalent, and it's a 10% of household deposits. And for a small bank, with a bank with less than $50 million in deposits, it has to hold 3% of household deposits. Corporate deposits, or term deposits, pardon me, 0. No reserve requirement whatsoever. Corporate deposits, 0. Overseas deposits, 0. Can you see a pattern there? Okay. The only thing that's got any significance for is for household deposits. So I think what's going, and when you look at it, when you do the measurement, and again this is another Federal Reserve paper, the model pretends that 100% of money is subject to reserve requirements. What they found is that only 8% of the total money supply was even subject to needing reserves in the first place. So 92% of the money in the economy didn't have any reserve requirement attached to it at all, because household deposits are fairly trivial compared to corporate deposits. Now that's from another 2010 Federal Reserve paper. So why hold reserves at all? Well, you need them for interbank settlements, but you do have it there in case there's a panic. And this is the Northern Rock event earlier this year. Northern Rock probably didn't have enough reserves, but I guarantee that there was a whole a fleet of what do they call those trucks that take money to banks? I can't think of the word all of a sudden. Pardon? Yeah, a money truck. It's called a money truck. They would have been flying there to give enough cash so the ATMs wouldn't run out. So 3% is probably enough to cover panic withdrawals, and certainly 10% would be for a big one. And what it means is the stock the banks have got on hand means that they can handle panics, and enough time for the Federal Reserve to send emergency cash if they need it. So I think that's the major reason why it's there. Let's take a break and I'll talk about how banks actually lend after that. Money is defined as, from that early definition from the Bank of England, it's bank deposits plus cash, fundamentally. So those are the 2 major forms that money is stored in, and they said 97% of course is bank deposits rather than actual cash, and they're created by commercial banks themselves. Now the way they do it, and again the bank makes this point, is when they create a loan, they record a liability you have to them, which is they're the debt, but they also give you an asset, which is cash you put in your bank account. And this is Alan Holmes and the whole thing. In the real world, banks extend credit, creating deposits in the process. So the act of lending actually creates the money. And then reserves, which are needed for various reasons we've already discussed, they look for after that. And the fundamental mechanism is double-entry bookkeeping. So you record a loan on the asset side of the ledger from the bank's point of view, and you record a deposit on the liability side of the ledger. And that's basically the mechanism for creating money. And have you ever seen this equation, assets minus liabilities equals equity? Okay. That's the basic accounting equation. And I wasn't aware of the significance of this until I started developing my software package Minsky, because I originally had single entry bookkeeping, but this is an incredibly important structural guide to how money is created and what the actual constraints are on the banking system. So it's really worth learning this stuff, and Minsky is designed to teach it. So you have loans increase the bank's assets, and the deposit increase the bank's liabilities by exactly the same amount. But of course what doesn't change in that process is the equity the bank currently has. So again, lending will change the ratio of the bank's assets to its equity. And so just showing this in a simple illustration here, if you have lending, that's going to increase the loans and increase the deposits. So that those two go together. If somebody repays the loan, that's going to decrease the loans and decrease the deposits. Okay? And that's an equal change in both cases between assets and liabilities. They both change by the same amount. Now, if you have somebody paying interest on the money they've taken out, then that's going to decrease one liability, but it increases the bank's equity. Okay? And that's a link I'm going to explore in a bit more detail as we go on in the lecture. So there's those are your basic operations going on there. Liabilities fall, equity rises. Those are the basic functions of money creation and then paying for the money that's being created. Now, I know that this is something which you're probably more familiar at Kingston than you would be at any other university in this, but it's still a bit foreign. And a lot of people, Krugman, you'll see Paul Krugman rubbishing anybody who says banks matter in macroeconomics on the basis we're banking mystics. Well, I think the mystics are people who believe you can have a capitalist economy without banks. And it really is the case that banks can easily create money out of nothing. And my best example of that was this guy. Let's go back and take a look at him. This guy. Because he ran a service station, a petrol station in New Zealand, and he applied for a $100,000 overdraft with the bank, I think with Westpac. And there was a mistake by the clerk, and notice gave him access to 100 times the intended amount. Not 10% more or 3% more, 100 times as much money. And he tells his girlfriend that he's effing rich, okay? And they withdraw 6.8 million, virtually 70% of the money. They take it out of the bank account and whack it in bank accounts in Hong Kong and China. He ends up going to jail, okay? But notice this whole thing. He applied for 100,000. A mistake meant he got 10 million. I love those sorts of mistakes. So what ended up happening? Well, if you know what bank keyboards look like, they've got special keyboards, okay? And they have a special 00 key. When you want to type in $100,000, you type 100,000 dot 00, okay? Rather than you type the 0 twice. Either the keyboard jammed, or the clerk didn't press the key hard enough, or something else went wrong. But effectively, by doing one less keystroke, that clerk created 100 times as much money. Now, there's no other industry on the planet where slightly less input creates 100 times as much output. Okay? The money is very, very different to anything else in the universe on that front. So, to show you that in Minsky, I built Minsky so we could actually model money creation, and it uses double-entry bookkeeping as an essential part of showing how money is created, and then generates a model of how all the flows occurred. And it uses two conventions to do that. First of all, it shows assets as a positive. So whenever you're looking at somebody's assets in Minsky, Minsky will show the assets as a positive. Liabilities and equity are shown as negatives. Now, that makes plenty of sense for liabilities, because with liabilities, it's something which detracts from your overall wealth. It's a convention for equity, because equity is, you own equity. It's not a negative for you. But we have that convention so that any operation across any row is going to sum to zero. So it's just a check, or it's a logical check. And it's a bit like what electrical engineers do. They model the behaviour of electrical circuits by saying the electric current flows from the positive terminal to the negative terminal. Now, we know, in fact, electrons are negative. Okay? So we should actually reverse that around, but the convention makes more sense. So in that sense, this is a convention that makes it easier to understand what's going on, and I do exactly the same thing. All flows are from positive to negative. So that previous table, I've got increase being plus here and increase being a minus over here. Then for when you have repayment, that's a plus because it reduces the liability the bank owes to you, and it's also a negative over here because it reduces the asset the bank has. And then this one is a plus to minus, so that's the basic logic of putting a model together. And what I've done here is just build a model where there's reserves, the bank has assets of reserves, assets of loans, and the liabilities of firm bank accounts, workers' bank accounts, and then finally, that should be equity there. There'll actually be an equity statement for the bank. Let's see if I can actually, I'll bring that one up later and fix it up. Okay, so there's the lending, positive to negative. There's repayment, positive to negative. There's servicing, positive to negative in each case. That's wages being paid, workers consuming, and banks consuming. So it's an incredibly simple model. And what I then do, you define the flows using a flowchart logic, and I'll show you that in a moment. But here, for example, I've got, let's see what the interest payments are. Interest payments by firms are equal to loans multiplied by the rate of interest on loans. Simple equation like that. So when you draw a flowchart like this, you're actually defining equations like the ones over here. And that's what we're now looking at, as the dynamics of this system. How does it actually behave? Now, if I bring up, where's my model? Here we go. Okay. So that's the Minsky model. This has the double entry bookkeeping table inside it. And that's exactly what I've shown you a moment ago. I'll fix up that error now that I've got where I'm showing the bank position as a liability. It's actually equity. So I click on this button and choose equity. That won't make any difference to the overall behaviour of the model, but it just makes it logically correct. Okay. Come back and save that here. Now, notice I've got little sliders here, and I can vary the rate of lending and vary the rate of repayment. So I'll start where lending and repayment are at the same speed. This number here for workers says the amount of money in the workers' account multiplied by a consumption rate for workers tells you what their consumption payments will be to buy goods off the firm sector. And I've got 26 there. Any idea why I might be using the number 26? Any guess? Any reason why I'm using 26 for the number for workers there for the consumption rate? It says, it's what it's arguing is that workers spend their wages on a fortnightly basis. There's 26 fortnights in a year. So the amount of money in workers' accounts will turn over sort of 26 times in a year. But you can vary that and see what happens. Let's actually start running the model. I'll slow it down so it runs at a reasonable speed. And I can now change the rate at which workers consume. Notice GDP increases because workers are consuming more rapidly. It falls if they slow down. So you see there's various effects on the system, but there's no change in the amount of money in the economy by changing how fast workers consume. If workers consume more slowly, what do you reckon is going to happen to GDP? It'll fall. Okay. The graph is a bit out of sight there. I'll just bring this graph up here. Hang on a second while I do that. I'm never quite sure how the display is going to work out on the screen when I put these things together. Let's start that again. So if I have consumers work, hang on, suppose I'm responding. Come on. I've got to go in too slowly. Hang on a sec. I'll just start that again. So changing the rate of consumption is going to change the rate of GDP in the economy, but there's no change to the money stock. So those little changes basically keep everything constant. If I change the rate of lending, then notice the amount of money in the economy changes as well, and GDP changes too. If I change the rate of repayment, the amount of money in the economy declines. And notice what's happening as I change all these various levels of lending and repayment. The ratio of loans to equity changes dramatically. So I'll leave that one up at that level. I've now got a ratio of loans to equity of 10, 9.5, say 10. So changing the amount of money that's being created by loans or cancelled by repayments changes the ratio of the loans to the equity of the bank, where the equity is generated by the interest payments that the firm sector is making. So varying that rate of repayment and repayment lending changes the leverage of the bank. And that's the essential point I want to point out here, because that's the answer to that final question, which is, what are the constraints? So if you vary the rate of lending and vary the amount of leverage you're creating in the economy, you're also going to vary the amount of equity you've got compared to that leverage. And if some of the loans go bad, which they will do, then to cope with that happening, you have to write off some of your equity. So the bank takes a hit whenever a bad loan occurs. It has what's called loan loss provisions, which are, you divide equity to include things like money set aside in case loans aren't repaid. But I think that's the main constraint. It's how willing banks are to have a high level of leverage between what they've got as equity and the amount of loans that they create. Now, of course, that's a very elastic control, because the more adventurous banks get, the more they think boom conditions apply, the bigger a ratio they're going to be willing to have between their loans and their equity. And that's what happened back in we're talking about the savings, the subprime crisis and so on. The amount of leverage banks were willing to have became absolutely enormous. And the most famous, of course, being Lehman Brothers. Now, the argument here is that they're talking about it borrowing money. It's really the ratio between its outstanding loans and its equity that I'm focusing upon. But they're saying it had a 44-to-1 ratio. And, of course, that means if 2% of loans go bad, that can wipe out the entire equity of the company, which is why it fails. So that's the main constraint, is the willingness of the bank to handle that level of leverage. And they're leaving that out. And so that's the main control. Now, the final thing is to say, well, does debt matter macroeconomically? Because the mainstream argues that it doesn't, for the simple reason they say for every debtor there's a creditor. So if you have somebody who is constrained by the level of debt they're carrying, somebody else is going to be getting income out of their debt and won't be constrained. And this is Krugman rejecting the arguments of Richard Koo to explain the Japanese crisis, because Koo said the entire country was balance sheet constrained. He called it a balance sheet recession. And Krugman says his vision makes no sense, because where there are debtors, there must also be creditors. So there have to be at least some people who can respond to lower real interest rates, even in a balance sheet recession. So he's saying, forget about Koo's arguments about the entire economy being constrained. It must make no sense. Well, the reason it makes no sense to Krugman, again, this is one of these general principles leading you astray, is they have this model they call loanable funds. Have you heard that expression before? Apart from me? Okay. And that treats banks as just like introduction agencies that introduce a borrower to a saver and arrange them, borrower and saver, to make the loan between themselves, and the bank charges a fee. So if that's the case, if the borrower repays the saver, then the borrower is going to have less spending power, but the saver has more, and the two cancel each other out, pretty much. Okay? And that's the reason that they think the level of debt doesn't matter. And when you look at their models, banks don't actually lend. This is a model from with Krugman and Eggerson put together in 2012, and they divided the firm sector into a consumption goods sector and an investment goods sector. And the consuming sector's agent lent to the investment sector's agent. The bank didn't actually do the lending. So you had the investment agent paying interest to the consumer agent, and the bank charging a fee for arranging the loan. That was the whole logic of the system. Now, what I've done is I've put that in Minsky, and I think I've shown you that a couple of times, but I'll go through it a bit more slowly this time around. So they both hire workers, which means they've got to pay wages to workers. They both buy output from each other. So the investment goods sector buys consumer goods, and the consumer goods sector buys investment goods. They both sell output to workers and to the bank. And then the investment agent changes how fast he or she borrows and repays, and you check and see what happens to the economy. And the answer is nothing much. And I'll show you the table first of all and then go to a simulation. So the table itself, again using our convention of Minsky, where all flows are plus to minus, and where assets are positives and liabilities are negative. The only asset the banking sector here has is reserves in this model, because it doesn't make loans. And then the liabilities are the investment account of the deposit account of the investing agent, the deposit account of the consumption agent, the deposit account of workers, and bank equity. And notice all rows sum to zero. So that's 100 there, That's going to be a minus 100 here. And then you have lending. The consumer sector lends to the investment sector. That reduces the amount of money that the consumer sector has in their bank account. That's why it's shown as a positive there. Increases the amount of money the investment sector has. That's why the minus applies there. So that's the act of lending. And the repayment goes in the opposite direction, and you've got interest payments going across here and fees being paid here and so on. This is wages for workers in the consumer sector, wages for workers in the investment sector, purchase of consumer goods by the investment sector, purchase of investment goods by the consumer sector, workers consuming goods from the consumer sector only, of course, bankers consuming from the consumer sector, and bankers also investing. But that's the basic flow logic. And notice there's no sign of debt there, because the debt is neither an asset nor a liability of the banking sector in this model. So to show it, I have to have another table which shows the consumer's point of view. And now notice that the consumer deposit account is now shown as a positive, because we're seeing it from the consumer sector's point of view, and it's an asset, so it's a positive sum. So the act of lending is going to reduce that asset and increase this one. Okay? So the flow is still shown from positive to negative, but in fact there's a reduction in the amount of cash that the consumer agent has, offset by increasing asset, the debt the investment sector owes to it, which can earn income, which is where the interest payments turn up over here. So let's simulate that model. And again, if you just install Minsky, you can do this yourselves. And I'll just slow this down a bit here. This changes the rate of lending. So if I make that a smaller number, lending happens more rapidly. It's saying how many years does it take for loans to double, effectively. So I'm saying it's 7 years here. If you make it 5 years, loans increase more rapidly. If you make it 30, they increase more slowly. And the same for repayments. Let's simulate this. And now if I increase the rate of lending, notice the growth rate actually drops. GDP, as you can see over here, is still pretty much flatlining. If I make repayment happen much more slowly, you notice the debt ratio, which is down the bottom here, is going astronomical. There's now more debt than there is money in the economy. I'll let it go on for a while. So there's a huge increase in the debt level. No change in GDP. Now if we go back to the stage where lending is really slow and repayments really rapid, a couple of blips to GDP there. It increased for a while with a reduction in the debt in the system, but it's now back to the same old level. So you've had a huge increase in the debt to GDP ratio and a huge fall, and tiny impacts upon GDP and upon the growth rate. So when they say the level of debt doesn't matter, working inside the model they have, that's right. Okay, it doesn't matter. But what I can do with Minsky, and I'll do this live and I'll do it slowly because I stuffed up I tried to do this at a conference and looking at the audience and trying to do it at the same time I deleted something I shouldn't have deleted. Well, let's see if I can do it here for you. It'll be slow because we had to rewrite the software for, again, this is more fun with Windows. Windows stuffed up how it showed up and down arrows. So we had to put a graphic overlay on top, and it's incredibly slow. It'll rewrite and rewrite and rewrite numerous times. I've got a couple of errors in the table. They're not quite certain where they came from. Let's see. Consumer goods sector. I think I need a minor cent over here. I'll put that in. What Minsky does is it looks at any entry you have, and if there's not a negative entry over here, then it shows you've got a non-zero sum over here. So to make this accurate, I need to type minus INT there to show the interest payment going to the equity of the consumer sector. I've got to wait for these refreshes to occur. And then the fee being paid by the consumer sector to the bank, which reduces the amount of equity that the consumer sector has. And I haven't recorded the level of debt properly here, so I've got the asset of 60 here for the deposit account, plus 10 here for the debt that the investment agent owes to the consumer agent. So the net worth is actually not minus 60, it's minus 70. So I can use the arrow keys to go and change that. Now I've made that table consistent. So that's the accounting checks the software package forces on you. Now I'll just save that once these updates stop. Okay, I'll just save that back to the system. But what I want to do now, that'll make no change to the behaviour, it'll still behave in the same way. So it's just getting there's no effect on the logic of the model, it's just showing it properly in the tables I needed to fix up there. Okay, let's now go and change this and say, well, it's not true that the consumer agent does the lending, the bank does the lending. So I can do this hopefully slowly and hopefully accurately. I can delete any of these columns. So what I'm showing here is the debt is an asset of the consumer sector. It's not. It's an asset of the bank. So let's delete it from here. Once I get control of the arrow keys back. Okay. Once I've done that, a lot of stuff is going to be unbalanced now. So you notice I've got lending and repayment being shown over here, but no matching point over here. I need to get rid of lending, debt repayment, interest payments and the bank fee because they don't go to the consumer sector, they go to the bank. So let's get rid of the lending operation, delete that row. This is currently in with my program as a bug report. I've got to get this sped up dramatically. Get rid of the debt purchases, the debt repayment, pardon me. Get rid of the interest payment. And get rid of the bank fee, which is just a fiction. And to be complete, what I've got to now show is that the consumer sector is worth 10 less than I had in the initial model because they don't actually have debt as an asset. So this is, I don't actually need to just make the model run properly, but I'll still do it for completeness purposes. Where has it got to? There we go. Now that should, there we go, 60. Okay, so that table's now balanced. Now what I'm going to do is go to the bank and see the economy from the bank's point of view. Again, this stuff has become incredibly slow in the latest version of the software, so I've got to get this fixed. Notice lending and repayment, interest payments and fee are still shown there because I haven't deleted them from the banks table. I'm waiting for this. Oh, there we go, okay. Make it a bit larger. And the program is now pointing out all the errors, all the levels where things aren't properly defined here. What I need to do first of all, though, is create an additional column as an asset for the bank. And the program remembers that there's still a liability of debt because I've got rid of the debt being shown as an asset of the consumer sector, but it's still a liability of the investment sector. So if I, once this finally refreshes, notice the drop-down arrow here. If I click on that arrow, it tells me any liabilities that haven't been allocated as an asset to somebody else yet in the system. Click on D, and that now says debt as an asset of the banking sector, and it brings across the lend and repayment operations that are still there in the system. Not the interest payment, because I've deleted the interest payment being shown as going to the consumer sector. So I've got to make a few changes there. I got flustered by this happening so slowly when giving a conference presentation that I made a mistake in making some of the changes. So I need to get rid of the bank fee because that's just a fiction. So we delete that particular row. The program's already taken care of lending and repayment because they were for operations that were brought across from bringing in the extra column. All I need to do now is first of all say that the bank actually gets paid the interest. So I've got to put a minus INT in here to balance that row out. Don't know why that's happening. Okay, minus INT. It could be my mouse that's causing that rather than the software. Okay, so minus INT there. And delete that little minus sign that's just been dropped in there by accident. The wonders of writing software. Here for finding bugs and getting rid of them. I'll leave it at that. I won't bother fixing up that little hassle on the total worth, because that's only just an accounting recording entry. It's not part of the logic of the program. Now I'll reset the program. And now I'm really stuck with the bug slowing things down badly. Start at the same situation of lending doubling every 9 years and repayment halving every 9, 7 years and 9 years. I'm hoping that road sign doesn't get in the way. There we are. So you get a positive growth rate straight away. You can see the growth rate is increasing. You can see the debt to GDP ratio is rising, and the amount of money and debt are both rising because the lending is creating new money, and it's also creating new spending power, because it's being used to finance purchases by the investment agent that the investment agent couldn't otherwise make. If we now have an increase in the rate of lending, the growth rate rises. If repayment occurs more slowly, the growth rate rises even more. And then if we have people decide to pay their debts back more rapidly and banks lend more slowly, the growth rate plunges. You might even go into a recession and GDP falls. Put it back to the original. Yeah. No, it will. I'll let it stabilise. It will stabilise at some point. Practically speaking, it does tend to rise until we have a crisis, and I can explain the logic of that. Pardon? It goes up. The ratio tends to rise over time. Yeah, and what that leads to is the financial crisis, and people don't want to borrow money anymore. That's a fairly modest. I've got a very simple model there. That's only a debt ratio of about, I think it's about 25% of GDP. Let's see, right click and check. 30% of GDP. If I increase these factors, make lending happen more slowly, for example, or the repayment happening more slowly, once the program reacts to what I'm doing, then you get a rising ratio. So changing the rate of repayment or lending will change the debt ratio. But it also changes the level of economic performance. I've actually modelled effectively a slump and a recovery in the economy there. So changing the amount of debt matters drastically to macroeconomics. And it's back to the presentation again. In the real world, when you vary the rate of lending and vary the rate of repayment, you have a dramatic impact upon the performance of the economy. And that's the final version of those changes stored in that particular model. So you change the rate of lending, change the rate of repayment, you'll change the rate of amount of money in the system, change the amount of demand and income as well. You'll have a boom and a slump. And this is what we should have learnt from the financial crisis back in the 1929, but we didn't do so. And I just want to go to another presentation if I can find where I put it. Let's see. Okay. So I'm pardon, I didn't get a chance to finish the presentation properly, but I can use all this logic to explain where the financial crisis came from. Because when you take a look at the declining rate of inflation rate and the declining unemployment rate, what the conventional economists were ignoring, because their prior logic said the level of debt doesn't matter, they were ignoring this increase in the ratio of debt to GDP over time. But in fact, that increase in the level of debt was financing growth in the economy, being more and more based upon credit. You get to a point where people are carrying so much debt, people meaning corporations and households. They're no longer willing to borrow money anymore. When they stop borrowing, the economy plunges. So we should have learned that lesson from the crisis we saw in Japan and the crisis we saw in Sweden and crises everywhere else. We fail to learn it because the mainstream just ignores the role of private debt. So I want to show you some charts and just show you how astronomical that level of debt's got to be while the mainstream has been ignoring all this stuff. So the Japanese crisis is the key pre-Great Recession crisis we could have learned from. And you see that right back from 1980, in fact going right back to 1970, there was a rising level of debt to GDP in Japan, financing what they literally called the bubble economy. Then the crisis began in 1990, and I'll show you why the crisis began there in a moment. The level of debt peaked at 220-something% of GDP. It's been on a long decline since then, and then since about 2005, it's gone sideways at about 170% of GDP. Now, you can see the UK had a rising level of private debt until after the global financial crisis hit. Now it's been deleveraging. The Americans, rising level of private debt until after the financial crisis, they're deleveraging. Spain, rapid rising amount, falling afterwards. It's a totally common pattern, and this is why I'm going to disagree with Hegel. If you understood this general principle, we wouldn't be in the crisis to begin with. We'd know what to do to get out of it as well, which is clearly not the case right now. So the reason the crisis began in those particular times was because the rate of growth of private debt slowed down. So here's the rate of growth of private debt in Japan now compared to the unemployment rate. And you can see the rate of growth of private debt was between 15 and 25% of GDP, reached a peak of about 28% of GDP. By this stage, debt had reached about 170% of GDP in Japan. Then the rate of growth of debt started slowing down and finally turned negative in about 1998. And from 1998 on, for most of the time, people have actually been reducing their debt levels rather than taking on new debt in Japan. Look at what happened to unemployment. Unemployment moves in the opposite direction because the extra money borrowed into existence means more demand and more income, which therefore drives down the unemployment rate. But if the rate of growth of private debt slows down, the unemployment rate increases. And that correlation is ridiculous. It's minus 0.91 from 1968 through to today. So it just shows how powerful this debt-based analysis is, and the mainstream ignores it. Now the United States, this is the United States data. The rate of change of private debt on the red line, the unemployment rate on the blue. Correlation minus 0.93. So it's not actually just a correlation argument, it's an argument about causation, because the change in debt is driving the capacity to hire new workers, which reduces the unemployment rate. Now when the change of debt goes from being, dramatically high as it was back here, 15% of GDP, and then it plunged very, very steadily down to minus 5%. And that decline in the rate of growth of private debt is what caused the crisis. You needed the preceding increase in debt to make it significant to begin with, but the starting point was that decline in private debt. And it applies universally. Every country you look at, you see the same sort of story. So I now want to make a forecast about what we can expect for the next 20 years, a fair bit of your working lives. I think Japan gives us a pretty good analogy, because unless we reduce this level of private debt by a more effective mechanism of letting people go bankrupt or simply pay their debts down over time, we're likely to face a similar trajectory as Japan has done with private debt levels. We've all got to much the same level, maybe not as quite as high as Japan reached, but we're likely to go sideways for most of the next 15 to 20 years. Now, if we do that, pardon me, I thought I had another chart there which I don't have. If you then look at the rate of change of private debt, I'll go back to that one a bit earlier and show it to you. It implies that this experience of Japan is likely to see what we can expect in the future. So the private sector will sometimes borrow money, and that'll cause a bit of a boom, but most of the time it's going to be deleveraging, reducing its debt level. And when it does, demand will fall and unemployment will rise. And that's the trap I think we're caught in right now. And it happens to be, in terms of the scale of the trap, it's the biggest trap we've ever had, because when you take a look at the historical data, going right back to the 1830s, the level of debt we're facing, private debt we're facing now, is bigger than at any time in the history of American capitalism. Now, that's the best data series I could find. I had to do a bit of engineering to take modern data and tack it onto old data, going back as far as I could find. But you can see almost all the way through, the level of private debt far exceeds the level of government debt. Okay? The one that politicians focus upon and see as a sign of bad management is actually frequently 1/2 or 1/3 or even less the level of private debt. And I think far less problematic than the politicians think. So, using the type of analysis I've shown you about the level of private debt, I was able to see the crisis coming, and so was Wynne Godley well before me, using sectoral balance analysis. And there's a relationship I haven't explained in logic here. If I had more time, I would have finished this lecture, but I just ran out of time with the workload I've got at the moment to finish putting it all together properly. But what you can argue as well is that money isn't just borrowed for to buy goods and services and hire people. It's, of course, it's mainly borrowed now to speculate on asset markets or housing markets and shares and things like that. So if you look at the market for housing, let's say, and you want to work out what's going to give you stable house prices, then on one side you can have a flow of demand, which is new money people are using to buy houses, and on the other side a flow of supply, which is physical houses. And you can see the price of the houses is trying to set those two flows to be equal to each other. Well, the demand is new mortgages, fundamentally, which is the rate of change of mortgage debt. So if you think in terms of differentials, you have DDT. You know that expression, DDT, for rate of change? Rate of change of something? Okay. DDT of mortgage debt will be equal to the price level times the value of housing. So there's a relationship between the change in level of mortgage debt and the level of house prices. But if you then differentiate, you get the acceleration of mortgage debt related to the change in house prices. So you need to have accelerating mortgage debt to have rising house prices. And this is the relationship in the American data. So mortgage acceleration, not just the velocity rate of turnover of new debt, but increasing level of private debt, drove up house prices, and then when it turned to deceleration, drives house prices down, and you're now getting a recovery because house prices are rising again because acceleration is positive. Mortgage debt is rising at a faster rate. And that correlation, again, is ridiculously strong for a single indicator. The same thing applies with margin debt on the stock market. So this is acceleration of margin debt and change in the S&P 500 in America. Again, with a ridiculously strong correlation for data that's that chunky. And it applies in China as well. This is phenomenal data I've just actually recently acquired, showing the Shanghai index, which you know is crashing again right now. Well, it actually had a bubble and a crash back at the time of the financial crisis, which you didn't hear about. And a major reason why you didn't hear about it was there was no margin debt. Margin debt actually began being issued in China in 2010. Pardon me, but let me go again. At that stage, margin debt was 0.0000014% of China's GDP. It hit 1% of GDP in early this year, peaked at over 2%, is now plunging down to 1%. So that dynamics are driving the gyrations of the stock market in China as well. And when I look at the acceleration of margin debt and the change in the Shanghai index, and you see the same relationship building up as you approach 2015 when you start to get substantial amounts of margin debt. So all these gyrations we're seeing on stock markets around the world are also being driven by all this behaviour with private debt. So that's a sloppy end to my set of lectures here. I'll leave it